And in your book, you talk a lot about velocity and monetary velocity. And then the second part of the book is more about the economic consequences of the policies by governments, and especially in the US. Velocity is something that you keep on hammering about. Right now, velocity of M2 has decreased a lot over time, like it halved from a little bit more than 2 to a little bit more than 1, even though the monetary base has doubled, the Fed balance sheet has doubled. We see that the velocity has halved, so the effect, I guess, is neutral. And without velocity, there's no economy. What would be the best way to increase velocity to make people spend again?
Well, the important thing is that velocity is a psychological concept. It's not a monetary concept. The Austrian economists, monetarists, neo-Keynesians all have the view if you print a lot of money, you'll get inflation. And that's just not true. Milton Friedman was wrong about that. It's not the money printing that causes inflation. It's the velocity. It's the turnover of money. And the quantity theory of money is just an identity. People say, well, doesn't that prove if velocity's not constant, doesn't it prove that quantity theory of money doesn't work? No, I mean it doesn't prove that at all. The quantity theory of money is just a definition. It's like saying A equals A. What it proves is that velocity is not constant. You have to, it's good for thought experiments, but as a guide to policy, it's challenging because you can't. What Milton Friedman did, he held velocity constant and said you could dial up or dial down the money supply and with a cap on real GDP potential and no desire for inflation. If you want P to be 1, Q to be 3.5%, and you hold velocity constant, you just dial the money supply up or down, and you get maximum real growth with no inflation. That was nirvana. The only problem with that is that velocity is not constant. It was a wrong assumption. And we see that, you mentioned them too, but you can, there's slightly different velocity numbers depending on the money supply, whether you use M0, M1, or M2. But M1, the fall is even steeper. It's gone from about almost 11 to 3. It's been cut by 2/3. So yeah, the Fed has doubled the money supply practically, but with velocity dropping like that, the nominal GDP is up barely. Well, it's not up, and we're still below 2019 output levels. So I remind people, $7 trillion times zero is zero. If you don't have velocity, you don't have an economy. So the question is, how do you get velocity to change? That's psychological. It's based on expectations. You have to get expectations to change. So central banks think that they can do it by holding interest rates at zero. But what message is the central bank sending when interest rates are zero? They're saying that they're worried about deflation. Well, if you're worried about deflation, why should I spend money? I'll just hold on to my money and wait till prices drop and go buy things more cheaply in the future. Or in fact, the real value of cash increases in deflation. So I'll increase my allocation to cash. I'll increase my savings. So the Fed doesn't understand any of this. They just don't understand monetary policy. They think they're acting in a stimulus way. They're actually impotent because they can't control velocity. And by holding rates at zero, they're sending a signal that they're worried about deflation. So people will save more and spend less. So you're getting exactly the opposite results. Now, how do you change velocity? How do you change expectations? You need to devalue the dollar, but not against the euro or the yen or sterling. I mean, that's all irrelevant. Those cross rates, they trade in a band. I mean, if you're a currency trader, if you're a currency trader, you care about it. If you're in the export-import business, you might care about it. But for understanding the value of currencies, the fact that they don't go to zero, they don't go to the moon, they just trade back and forth in a band, but they're all in the same boat. You're never going to have a world where people have completely lost confidence in the dollar, but they're flocking to the euro.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
That's not going to happen. The euro and the dollar are going to kind of go up and down together with some fluctuation in the cross rate. The only way to devalue the currency and change inflationary expectations is to increase the dollar price of gold.
Yeah, but you can also devalue all currencies against all commodities, right? So the central bankers can come together and jointly decide to produce more money, possibly via the emittance of more SDR, but they can jointly, of course, devalue against everything, not just gold.
Well,
just like they're doing right now by extending the balance sheets.
Well, no, they can't. As I just said, increasing the balance sheet doesn't do any good at all. What you have to do is do something else that would cause commodity prices to rise. Now, oils, gold has doubled in the last 5 years. Oil's going up recently. So that trend may be emerging, but it's emerging very slowly. You could accelerate that with a declaration that, just gold is $5,000 an ounce. And, if the Fed had an emergency meeting, took that vote, said gold's $5,000 an ounce. If you think it's cheap, come and get it. The doors of Fort Knox are open. If you think it's expensive, deliver it to us and we'll pay you for it with using the printing press. And if you use the gold in Fort Knox and the Fed printing press to maintain a market, you're a buyer at say $49.95 and a seller at $50.50, then the price of gold is $5,000 an ounce. And the purpose of doing that would not be to reward gold holders. I mean, it might do that, but that's not the idea. The idea is to change expectations and get the price of everything else to go up, because the world of $5,000 gold is also the world of $400 oil, $100 silver, $20 corn, etc. This has happened before. That's happened twice, once in 1933 and once after 1971.
And how much bigger will the Fed balance sheet be after they've completed that revaluation?
Well, it might not be bigger at all, but my point is that the Fed balance sheet doesn't matter. What matters is inflation expectations, and that's based on
people that read the newspaper and see about this then think, okay, we better start spending and start exchanging our money so the velocity goes up. Or because right now we see a lot of news articles about the central banks extending the balance sheets, but it doesn't lead to inflation expectations amongst consumers. But does a gold revaluation then, does it lead to inflation expectations amongst the common man?
Yeah, absolutely. As people understand gold, and as I say, it has actually happened. This is not theoretical. Franklin Delano Roosevelt did 1933 on purpose, and it worked brilliantly. Richard Nixon did it by accident, but it also worked. Look at the borderline hyperinflation by the late 1970s. So people will get it. But again, it's not just about gold. It's about expectations. And it's the easiest way to do it. It's the clearest way to do it, because gold isn't good for anything. Gold is a form of money. It's perfect for devaluing the dollar, as I just described. It's not good for anything else. It's not an industrial input like silver. It's not like they use it to coat space helmets and a few other things, but not much. People talk about jewelry, but jewelry is just wearable wealth. It's just gold you wrap around your neck, but you still treat it as a store of wealth. So gold is the perfect instrument. I mean, I suppose the United States could go out and bid up the price of oil, but why bother if you don't need the oil? Gold is a much easier way to do it.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members, where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. Build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active, and see you on the other side.